Indeed, the BG acquisition, as we see it, has worked out very well. We have delivered on all the commitments that we made at the time. We have delivered on the synergies, we've delivered on cost takeout, we've delivered on capital discipline, we're delivering on growth, we've protected the dividend, we turned off the scrip, and now indeed our cash flow and the pay down of our debt has brought us to the point that we are confident to launch the $25 billion share buyback program that we committed to at the time as well.
But I look at where your shares have come from as well. I look at the rally they've had on the back of execution of your strategy, on the back of the broader oil price. I look at the fact you've still got a pretty chunky dividend yield as well, 5.3% as well. I'm asking, is the market just asking for you to actually allocate too much capital to buybacks when you could be using that money elsewhere?
Well, I think we've been very clear with how we want to manage our financial framework. We've been very clear that we wanted to reduce debt to a level that was more manageable. And we said we want to have a clear line of sight to a 20% gearing as an interim point. We, as I said, want to protect the dividend, want to go back to a full cash dividend. And we were very clear that with a disciplined capital investment program, we would put the surplus free cash flow into further shareholder returns in the form of a buyback program. We wanted to take back not only the dilution that we have seen during the period that we had a scrip dividend on, but we also want to start taking back some of the shares that we issued as the BG acquisition took place. So this is part of the program that we have been announcing. You're right, our dividend yield is on the high side, so it will be advantageous to take some of our shares back that actually cost us a 5.3% yield. So I think this is exactly the right time to start this, and our intent to do $25 billion before the end of 2020 is very firm.
Let's just talk about the actual quarter itself as well, because I saw one of the highest estimates out there wanted a net income figure from you, Ben, of $6.4 billion. You've come in at 4.8. Can you just explain that miss for us, sir?
Well, I think our earnings are solid. There are a number of things in there. If you look at integrated gas, very good quarter, twice as good as the same quarter last year. Upstream, good solid quarter, 4 times as good as the same quarter last year. Downstream is lower. Bear in mind, downstream had one of its best quarters in Q2 17. Now we see a tougher environment for both refining and trading. We saw some higher costs this quarter in downstream as well as a result of a heavier maintenance program that we had. And then, of course, if you look in the oil markets, everybody will look at Brent up by 50%. But at the same time, WTI, to which we are exposed significantly as well, only up 40%. AECO, so the gas market in Canada, to which we are exposed, 50% down. Henry Hub, 7% down. So there are a number of moving parts in addition to exchange rate that often make our earnings a little bit more harder to understand than we ourselves would like as well. The key thing, though, of course, is all about cash. So if you look at our cash flow performance, and you exclude working capital effects, which are always there as well, we had an $11.6 billion quarter. That is the best quarter since the first quarter 14. And strictly speaking, Steve, you need to add back also the cash that we put into our LNG hedging program, the cash margining that is required there, which is another $800 million. So underlying, we had a $12.4 billion CFFO quarter, which is, of course, the quarter that we need to see. And that gives me the confidence that we are at the point where we can start our buyback program.
Hey, everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.